Okay, class, I'm really sorry for the video because I made it in a hurry and I didn't check for the quality of the voice, so I make this again. So here's the way now to calculate. For the first thing is we try to calculate for the credit line. So note that it is a short-term credit line. Okay, so the formula for this includes three parts. The first part is I call factor 1. Factor 1, that is about the cost need per cycle. Okay, for factor 2, that is about calling self-fund, and for factor 3, that means the credit is already approved in the other banks. Okay, so I'm going to calculate for this. So now imagine that I want to calculate for the credit line from 2016, 2017 and 2018. So here I'm going to have this. Okay, now the first thing is for factor 1. Factor 1. Now for factor 1, the first thing you need is the total cost that the company gonna need during that year. So here's gonna things. The total cost here is equal cost of goods sold plus 4 years. That means all of the costs include. Okay, so here we have all of the costs include here. Now the second thing you're gonna need is about a business cycle. How long does it get? Okay, how many business cycle per year? Okay, that is the number of business cycle per year. Okay, so how do you calculate for the number of business cycle per year? Now the first is you're gonna calculate from CCC. Okay, CCC, as you know, is going to be equal to the working capital. I have about day receivable here. Then I'm going to have my day inventory here. That's mean going to be plus for the inventory, and then I'm going to minus for my day payable. Okay, now I just come in and then I just format a little bit. Okay. Now here, as you can see, is that my CCC is negative. So this means that this is a good company. Okay, so which means that it does not need to have to borrow the money for short term. Okay, because why? Sorry, it's about this. Because in generally, that means that the company can generate money before that. That means, as you can see, sorry here, because as you can see here, I'm gonna turn this off. As you can see here, this means that, for example, during a year, so the number of day is let me see here, 214. So the day inventory is 52 and the day receivable is 27. So normally that the cash gonna need to be collected in about 27 plus for 52 days. Okay, this is the amount of time that need for the product from inventory and turn to the customer and turn to cash for the company. Now, but the company can delay for its payment for the supply for 224 days. Okay, so that means that during this time the company can keep savings. Okay, can keep the cash for itself for using for 135 days. Okay, so normally that is the good signal for the company. Now the point here is that, so I want to illustrate. So if it is CCC is negative here, so therefore that probably you no need to calculate for the credit line, short-term credit line. No need to calculate. Okay, so here I'm going to give you an example for about when you have the CCC to be positive. Let's say 50. Okay, if your CCC is 50, then I'm going to have about in a year, you're going to have about in a year 335 days. Okay, then if a business cycle, business cycle take you about 50 days, then the number of business cycle per year is going to be equal to 300 divided by 50. Okay, so that gives you about 7.3. Okay, I need to format a little bit. Okay, now the total cost here and the number of business cycle here. So therefore that one cycle gonna need an amount of money equal to this amount divided by this. Okay, and just a format. Okay, so this means that in one cycle the company gonna need about 1,400, 1,500 here, okay, to have it. So that means that's gonna be the amount of credit line provide for this company. But however, because the company have the fund by itself, so what does this mean? This means here is that according to about the theory in the bank, they believe that short-term assets should be financed by short-term liability, long-term assets should be financed by long-term liability and equity. Well, here is the allows, that is that long-term liability can fund for short-term assets, but not allowed is that short-term liability fund for long-term assets. Okay, so therefore he is going to see that. So we have about the self fund that is equal to long-term liability plus equity, then we're going to minus for the long-term assets here. Okay, so we're going to have the number 02, that's going to be equal to, I'm going to move to my balance sheet, and then I have my total equity here, total equity. Then I'm going to plus for about this one, long-term borrowing. Okay, so maybe depend on how you understand about this account, you may include it in. Okay, maybe this is belong to about the long-term liability, so you can include it. Then you're gonna minus for long-term assets here. Okay, so everything is okay. Yes. So here you're gonna have that. Okay, so this is the this is about the factor to number 2, that is the self one. Now number 3 is about the credit approved in the other bank. So here I make the assumption that we have no information about this, so that means that there is no credit line in the other bank. Okay, that's going to be 0. So the credit line for this company is going to be equal to this one, total cost, minus, oh no, sorry, where is it? Yeah, here. Equal to here minus for factor number 2, then you're gonna minus for this. Okay, so the point here is we have about a negative credit line is because that it's about we already changing something in the CCC. Okay, I should remember the CCC is here. Okay, so generally if you're following this, there's nothing wrong about that. Now before I leaving the credit line, there's some important note, that is this is just one of the method used in the bank. Okay, there's the other method to calculate. For example, factor 1, they may be calculated as equal to, for example, revenue. They're going to take about the revenue divided by 335 days. Okay, so to have about a credit line. So that means that the factor 1, I have to say you again that there are many approach. Okay, and CCC is not the only approach for this. Okay, so in the case of the company that have the CC to be negative, that means that this company is too much successful, and so therefore that the way to calculate for a credit line, well, you can get difficult or more easy. It's gonna be more easy because by its nature the company doesn't need the fund, so therefore that the credit analysis, they can, to my opinion, they can make up some number to suiting for them. Okay, now we're gonna leave this and we're gonna move on to about calculating the max debt. Okay, the max debt here you have the two methods, in which the method 1 based on the leverage. Okay, this based on the static trade-off theory. Okay, in which that the company has an optimum leverage ratio, and some other research they telling that by just taking about the average of the historical leverage give you the fair estimation of optimum leverage ratio. Okay, now for the method 2, okay, this method is easy, so I'm going to skip that. I'm going to go for method 2. That is going to calculate based on unleveraged free cash flow and EBITDA. Okay, so why do we need to use both EBITDA and unleveraged free cash flow? Because for the reason following. First, EBITDA stands for how much the company can earn. Why? Unleveraged free cash flow stands for how much cash available. Okay, so therefore that between the two, you're gonna have to choose the minimum. Okay, so here's the point. Assuming that I have my EBITDA here is gonna be equal to here. Okay, so here's my EBITDA. Now my unleveraged free cash flow, as my definition, that's going to be equal to cash flow from here. You have the cash flow from operating, okay, and you're gonna minus for, okay, here is already cash outflow, so I have to plus it, minus for the cash capex, capital expenditure. So but is that maybe if I have the other investment here, maybe the other investment here is about the cash inflow, outflow, so depends on you how well you understand the account. You may plus for this or may you plus for this. Okay, it's not a big deal since the other investment is account for very small here. Okay, then that is going to be equal to this, and then this is not finished, and then you have to plus back for the interest. I don't have time to give you an explanation why we have to plus back for the interest, or because the cash is this. You have to pay attention because here I denote everything very clear. The cash out is negative, cash in is positive, okay, in my income statement, which is different to the other income statement of the other author. Okay, so I'm going to minus here, multiply by 1 minus for the tax. Okay, so the tax here is going to be equal to here. Okay, so here is my unleveraged free cash flow. So between the two, I'm going to choose the minimum, which is okay. So after choosing for the minimum, then you need to determine is that how long the company going to borrow. Okay, so normally depends on the company. Normally for the SME, the debt is going to be ranging from 5 to 10 years for the, and some it's going to be 5 to 10 years for the some of the maybe large corporation, maybe about above 10 years. Okay, depends on you. So here you're going to have about, here I'm going to make an assumption of 10 years. Okay, if assumption of 10 years, so what is the factor do we have here? Say you're going to have 1 2 3 4 5 6 7, that's going to be 8 9 10. Okay, and assuming that I have the cost of debt, so how to calculate for the cost of debt? The cost of debt actually you can calculate by browsing into the debt schedule, and then you can have about the interest rate for short term, interest rate for long term, and then you calculate based on the weight average of the two factors or of the debt the companies currently have to have the fair estimation about the cost of debt of the company. Okay, so now I'm going to move back to the income, and I'm going to have my estimation here is that. Okay, before that I'm going to have the factor is going to be equal to, it's going to have my factor here is 1 divided by 1 plus for the cost of debt going to be equal to here. Where is my cost of debt I'm going to put? Okay, maybe I'm going to put the cost of debt here. Cost of debt I'm going to power by this one. Okay, now my cost of debt, assuming that after calculation is 5.2%. okay, so I'm going to sum them up. In this the class of FFM, you have the formula for this, and you can make the review on that. So yeah, I'm gonna have the sums of these. Okay, 7.64. So that's mean that where is it? So this is the key number that we need. So I'm gonna make it color a little bit. Okay, blue for example. And perhaps I'm going to make it a little bit formatting to make it good. Okay, now it's good. 7.65. That means is that going to between this, I'm going to choose for the minimum, and then wait for it. wait for it. Okay, now between that I'm going to choose the minimum, and then it's about the max debt allowance. It's going to be this one divided by no, it's going to be multiply by this one. Okay, oops, no, it should be this one. Okay, so here you're gonna see that the maximum debt for 2016 is 14,000, 2017 is 23,000, and here is about 14,000. So which one should you choose? Definitely you have to choose the smallest one here, which is this one. So the reason why, because if in the second year it's going to increase it to 22, about just say 23,000. okay, so therefore that in a year normally you're going to have to pay for this amount of money. That means that this is going to be, okay, this is gonna be the amount of money you're gonna have to pay, and then you have to pay them all, and then in the second year your maximum ability to earn is only this amount of money. So therefore it's gonna make you having some trouble, okay, later. So that is all about that. Okay, is there anything else I need to add on here? Well, no. Yeah, the final is gonna be this easy, and just all. Thank you for watching.